It's a beautiful November fall day in St. Louis. Welcome back. My name is Dan Davis, President and co-founder of ADK Wealth Advisory Group. Purpose for today really is kind of look back over the first 3 quarters of 2017 and then look forward into 2018. If I were going to kind of summarize things, I'd really say it's the best it's been since about 2005. Sounds a bit cliche and maybe even Pollyannish when you talk about going forward how good things look, but the reality of it is that the central bank policy that was implemented globally throughout the financial crisis is really bearing fruit now in what we see as the best economic growth globally that we've seen in literally over a decade. So if you look at Asia, you look at Europe, you look at US, if you look at GDP, corporate earnings, CEO and CFO forecast of expectations, literally those 3 categories are off the charts. If you really think about the why, I alluded to it a moment ago, it's central bank policy. The amount of stimulus that was put into the global economy is nothing short of staggering. My brain doesn't comprehend these numbers, but I'll throw them out there for you. The central bank Fed had a balance sheet pre-crisis of $800 billion. And now if you take a look at it, it's $4.5 trillion. All those numbers, and I do this for a living, don't work in my brain. But if I oversimplify it and say the Fed's balance sheet has more than 4.5 times itself, my brain can handle that. If you then look globally and you say, what have all the other central banks done? Collectively, it's about the same amount. So you're talking nearly $9 trillion of stimulus. Why is that our belief as to what's causing this growth? It's really that when you take a look at central bank policy, it's either stimulus, neutral, or tightening. And when you have stimulus, it's like a big tailwind that pushes things. And that's been what's been going on. If I were to say, what do I think about the central bank policy? There's really 3 phases. Phase 1 is quantitative easing. Phase 2 is normalizing balance sheet, and phase 3 is selling bonds. Quantitative easing, a quick 101, in this developed world, they use a fancy term like that. If it's an emerging market doing it, they say we're printing money and buying bonds, which is really what it is. The U.S. started that first. We are finished with phase 1. Now you hear all this talk about normalizing balance sheets. And what they're talking about is that as bonds that the Fed owns mature, they won't renew those, and so they'll take that cash off the table. And the effect of that should be important. If you take a look at the ECB, the Bank of Japan, they're both still in quantitative easing. So combine that with the Bank of England and the Bank of Japan, all of them are still in stimulus mode, where the Fed is more what I would classify as a neutral stance. When I really think about what my concerns are, they're not. I don't have central bank concerns until all of those central banks, including the Bank of China, are in tightening mode. And I don't really see that as a significant headwind until probably after 2020. When I then get back to the main questions that I hear clients ask us, one is, if the market's at such a high level, are we expecting it to go down? And the answer really falls in 2 categories. One is you have normal volatility. The other, you have abnormal volatility. I'll define those. We've talked about them in the past. Normal volatility post-World War II typically happens about every other calendar year. And it doesn't feel normal when it's happening because it can be as much as a 20% drop in the market. But the key thing is from peak to trough to peak, you're talking months, 6 months or less. Abnormal volatility, you literally have market collapse. So it's like a 2000 or a 2008. And from peak to trough to peak is years. We don't see anything out there that is highly probable that's going to cause market collapse. It wouldn't surprise us between now and the end of 2018 if we were to see something that was normal volatility. But again, that's months, not years. Overvaluations is the second question I hear about. Clearly, when you look across the globe, assets are trading at premiums. I don't see anything out there trading at a discount. but nothing is trading that we are invested in at a premium that would equate to a bubble. And that's important because with low interest rates, assets can trade for extended periods at premium valuations. The outlier is North Korea, and I don't really know a way to measure that. Is Kim a lunatic? Is he shrewd as a fox? Is he both? The answer is I don't know, and I don't think really many people do know outside of his circle of cronies. What we do know is that if he preempted something, China has stated that they would not back him. If America preempted his strike, China has stated that they wouldn't back us. So I doubt very likely that America is going to strike them. I think you're going to see years of back and forth types of negotiations. What I would hope for, candidly, is that China would step in and do something that would eliminate his regime and put in their own cronies. Likelihood of that, again, don't know. So I don't want to discount the reality that if something happens there, the cost of life would be dramatic. But the likelihood that the U.S. would preempt, I think, is low. So something like that, if it did occur, would be catastrophic to the markets for a short period of time. This, to me, would be like a 6 to 12-month ordeal. But I don't think it would be years. I think it would be, again, months. The kind of things that we're looking for outside of the black swan, like in North Korea, is what's the likelihood of a recession? When I look at LPL's research team and when I follow the Fed, the likelihood of a recession in the next 12 months is as low as it could possibly be. I never hear statistics saying it's less than 20%. The second thing we look at is what's happening with corporate earnings. If you have a pullback and corporate earnings are decent and there's no recession, it normally is very short-lived. If corporate earnings are plummeting and you have a recession, those kind of pullbacks are really severe. So let's do a quick review on corporate earnings. If you take a look at the S&P 500, the first 2 quarters you had double-digit growth, which was really a big impetus and push from earnings on energy. If you were to take energy out of it, earnings growth was about 8%. So it's really strong earnings growth year over year. If you look at year to date, we're in the third quarter, about 80% of the S&P companies have reported, and we're up about 8% year over year. The big drag has been around insurance companies affected by the hurricanes. If you were to remove those, earnings growth is about 11%. If you look at forecast for 2018, a little bit lower than what the forecasts were for this year. If you go to me, the most interesting investment area right now, and you do emerging markets, 43% of the emerging market companies have reported third quarter, 27% year-over-year growth. I mean, that's shocking. If you take a look at what the consensus estimate was, it was 24%. And if you look at the forecast for 2018, they're expecting earnings to increase by another 2% on top of all that. So the laggard, which is consistently the laggard, is sort of what I would classify as EFA, Europe, Asia, Far East. Europe, to me, is an area that will continue to underperform when you look at economic growth and when you look at earnings. When you do sheer returns, they're outperforming the 2 other industries we mentioned because they're doing less, but they were doing so bad for so long that even though they're doing less, they're getting a bounce up. I don't think it's a sustained long-term trend. For example, if you take a look year to date, third quarter, 70% of the companies have reported in the EFA, and you're talking 4% year-over-year growth. The consensus is still that they expect like a 22% growth rate, and that they expect next year for it to go up by about 7.6%. But in all, to me, the long-term theory that I have is U.S., Asia, those are the 2 areas that we think will outperform with the most reasonable amount of risk. Getting back to questions that clients ask us, market highs, overvaluations, North Korea, what do we look for? The things we look for are all pretty shiny right now. Again, it wouldn't surprise me if we saw normal volatility, but barring a North Korea, there's very low likelihood that some kind of a catastrophic market collision will occur. Now, as I alluded to earlier, much of that's because of stimulus. If I then move away from monetary policy, from the Fed, for example, and I look at what's going on in Congress, there's some fiscal stimulus that may happen. If you take a look at the tax plan, if you take a look at infrastructure spending, those could be additional pieces of stimulus that could cause the markets to do well and the economy to do well. Hard to say with our dysfunctional politics how that's going to play out. My guess would be that we would get some kind of a tax plan in place for the first part of 2018, and we'll see the effects of that in the market almost immediately, but we don't really see the effects of that till the second half of 18 and into 19. Infrastructure spending, who knows what's going to happen there. That's really not even been kicked around much, but anything that happens there, again, would be stimulus and focus. So if I were going to summarize all this, I would basically say the rest of 2017 and 2018 look better than they've looked in a long, long time. Very happy to be reporting that to you. We do have a belief that results in positive returns in equities, but not nearly like what we have seen so far in 2017. We do have concerns because of the Federal Reserve and some of the other ECB policies that are going to be happening. The ECB is cutting their quantitative easing in half effective J1, and we already know that the central bank in the U.S. is going to be causing some of their bonds to go to cash. When all happens, we do expect interest rates to rise, which hurts bonds. We still expect them to have a positive return, but very low. So in summary, I think thumbs up. We'll keep in touch. Thank you for your business. Please send this out to your friends and visit us on Facebook and LinkedIn. Have a great day from Dan Davis at ADK Wealth Advisory Group.